Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SANDS China Ltd. Annual Report. SANDS China Ltd. offers a diverse range of businesses and services in Macau. At the core of its operations are integrated resorts and casinos, including the Venetian Macau, the Londoner Macau, the Parisian Macau Resort, the Plaza Macau, and the Sands Macau Casino. These establishments provide entertainment venues such as Cotai Expo for conventions and exhibitions, and the Venetian and the Londoner Arena for live performances. In addition to its gaming and hospitality services, the company offers various supporting activities. This includes ferry transportation and leasing services through Cotai Water Jet, which caters to both leisure and business travelers. SANDS China Ltd. also provides other related services such as security, human resources administration, and outsourcing services like information technology, accounting, hotel management, and marketing. The company's extensive portfolio of businesses and services makes it a significant player in Macau's tourism and entertainment industry. Its operations are supported by its parent company, Las Vegas Sands Corp., which provides strategic guidance and resources to ensure the continued success of SANDS China Ltd. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for integrated resorts in Macau are multifaceted. One key driver is the increase in travel and tourism spending, particularly from mainland China. The expansion of infrastructure investments in Macau and the Greater Bay Area has also contributed to revenue growth. Additionally, the diversification of integrated resort offerings on Cotai, such as the development of new attractions and entertainment options, has helped drive revenue. Another significant driver is the focus on higher-margin mass-market gaming segment. Integrated resorts have also leveraged their scale of operations to create absolute cost advantages, leading to increased profitability. Furthermore, the identification and investment in targeted opportunities across the portfolio have driven growth. The increase in visitation to Macau, particularly from mainland China, has also contributed to revenue growth. The growth of Chinese outbound tourism market has further boosted revenue. Additionally, the development of new transportation infrastructure and hotel room inventory has facilitated increased visitor numbers. On the other hand, the primary drivers of revenue decline are largely related to taxation. The gaming tax on gross gaming revenue, which accounts for 35% of gross gaming revenue, is a significant contributor to revenue decline. Public development and social-related contributions, which account for 5% of gross gaming revenue, also contribute to revenue decline. Additionally, the special annual gaming premium paid if actual average gross gaming revenue per gaming table or machine is lower than the minimum amount determined by the Macau government further reduces revenue. Overall, while there are several drivers of revenue growth, taxation remains a significant challenge for integrated resorts in Macau. The net income of a company underwent significant fluctuations over time. Initially, it decreased due to various factors such as increased competition, changes in laws and regulations, and uncertainty surrounding tax arrangements with the Macau government. However, there was an increase in net income by $25 million from $422 million to $447 million at a later stage. The profit margins of different properties also varied significantly. While some properties like the Venetian Macau and Sands Macau experienced substantial declines in profit margins, others such as the Londoner Macau and Ferry and other operations showed notable increases. The Parisian Macau was an exception, with a decline in its profit margin. These changes can be attributed to the same factors that affected net income, including increased competition and uncertainty around tax arrangements. The company's financial performance indicates a consistent generation of positive operating cash flow. According to various pages in the extracted summaries, the net cash generated from operating activities has been steadily increasing over the years. On page 29, it is reported that the company generated $2.11 billion in net cash from operating activities in 2025 and $2.07 billion in 2024. Similarly, on page 109, the cash generated from operations was $2,117 million in 2024 and $24 million in 2025. These figures demonstrate a positive trend in the company's ability to generate cash from its core business activities. Furthermore, pages 162 and 174, explicitly confirm that the company is indeed generating positive operating cash flow. In 2025, the cash generated from operations was $2,117 million, while in 2024 it was $2,083 million. Additionally, page 172 reports a net cash from operating activities of $1,505 million. Overall, these figures and confirmations demonstrate that the company is successfully generating positive operating cash flow, indicating a strong financial position and ability to sustain its business operations. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, the weighted average total borrowings balance decreased due to the full repayment of LVS term loan on page 27. However, this decrease was short-lived, as the debt level increased by $12.75 billion, $0.64 billion, under the 2024 SCL term loan facility. Despite this increase, the company's total debt level has generally decreased over time. By page 98, total borrowings had decreased from $8.16 billion to $7.1 billion. This trend continued, with the total debt level decreasing slightly from $11.169 billion in 2024 to $10.571 billion in 2025. However, there have been some fluctuations in the company's debt level. For instance, on page 158, it is noted that the debt level increased by approximately $0.61 billion, from $1.61 billion to $2.22 billion, from December 31, 2024 to December 31, 2025. In terms of interest expenses, there have been some increases and decreases over time. Initially, interest expenses decreased by 14.4% from $431 million to $369 million on page 27. However, this decrease was not sustained, and interest expenses increased in subsequent periods due to various factors such as higher interest rates and increases in current portion of debt. On page 157, it is noted that interest expenses decreased due to a credit rating upgrade, resulting in a decrease in coupon rate on senior notes by 0.25% per annum. However, this decrease was short-lived, and interest expenses increased again in subsequent periods. Overall, while the company's debt level has generally decreased over time, there have been some fluctuations in recent years. Similarly, interest expenses have increased due to various factors, including higher interest rates and increases in current portion of debt. Management is optimistic about the future of SANDS China, citing Macau's potential for growth in travel and tourism spending. They believe that the integrated resort model will continue to drive business, with a focus on developing Cathay into Asia's premier gaming, leisure, convention, and meetings destination. The company aims to leverage its scale and investments to achieve consistent demand, longer average length of stay, and higher margins. Management is confident in the long-term growth of visitation to Macau, driven by factors such as urbanization, tourism market growth, transportation infrastructure development, and hotel room inventory increase. They plan to drive higher-margin mass-market gaming while providing luxury amenities to VIP and premium players. The company will also introduce more modern and popular products that appeal to the Asian marketplace. In addition to its gaming strategy, SANDS China is investing in non-gaming projects, committing at least $4.47 billion by December 2032. This includes developing Macau's transportation network to drive visitation to Cathay and improve customer experience. Overall, management is focused on executing a straightforward business strategy that prioritizes growth, innovation, and customer satisfaction. The acquisitions made by VML include entering into a 10-year gaming concession contract with the Macau government, allowing them to operate in the region for an extended period. Additionally, VOL acquired franchise rights to operate the Londoner Grand as a Marriott Luxury Collection hotel brand, expanding their portfolio of luxury hotels. On the other hand, VML has made divestitures by agreeing to revert certain gaming equipment and gaming areas back to the Macau government without compensation. This move indicates that VML is relinquishing control over some of its assets in Macau, potentially as part of a strategic decision or regulatory requirement. The company's financial activities have been well documented in its reports. One notable aspect is the payment of dividends to its shareholders. The records show that the company has indeed paid dividends on multiple occasions, as evidenced by various pages in the report. In addition to dividend payments, the company has also engaged in share buybacks. Although not explicitly stated, a mention of restricted payments on page 35 implies that the company has utilized this method to purchase its own shares. This indicates that the company has taken steps to reduce its outstanding share count and potentially boost shareholder value. There are concerns about inventory buildup or supply chain disruption in the company's operations. One area of concern is the reciprocal procurement services, which has a significant value of $0.9 million. This suggests that the company may be relying heavily on external procurement services, which could lead to inventory buildup if not managed properly. Another area of concern is the transportation and related services, with a substantial value of $10.6 million. This indicates that the company's supply chain is heavily reliant on transportation, which can be vulnerable to disruptions such as traffic congestion, natural disasters, or equipment failures. If these disruptions occur, it could lead to delays in delivery and ultimately affect inventory levels. The International Trademark License Agreement also raises concerns about inventory buildup or supply chain disruption. With a value of $118.3 million, this agreement suggests that the company is heavily invested in international trade, which can be complex and prone to disruptions. If there are issues with customs clearance, tariffs, or other regulatory requirements, it could lead to delays in delivery and impact inventory levels. Overall, these concerns highlight the need for the company to carefully manage its supply chain and inventory levels to mitigate potential risks and ensure smooth operations. That concludes the financial summary for SANDS China Limited. Feel free to comment below, and I will be happy to answer them when possible.